Hi, my name is Blaine Pacelli, and this is my November 2015 real estate report. Stocks have best month in 4 years. The stock markets closed the month with the Dow and S&P up more than 9% in October. After dropping about 10% in August and September, October's rally came as a welcome relief to investors. The Dow Jones Industrial Average closed the week at 17,663, up slightly from last week's close, 17,646. The S&P closed the week at 2,079, almost in change from the previous week's 2,075. The Nasdaq closed the week at 5,053, also about the same time as the previous week's close of 5,031.86. Third quarter GDP rises at a disappointing 1.5% annual rate. The U.S. economy cooled in the July to September quarter to the rise of the annual rate of just 1.5%. This follows an annualized rise of 3.9% in the second quarter and was well below experts' expectations. Much of the drop in production stemmed from the largest drawdown in inventories in 3 years, as companies cut back on producing products, especially those for overseas markets. The drag on production was caused mostly by a cut in inventory levels and is thought to be temporary by experts. They expect GDP will pick up in the fourth quarter as companies now feel they are no longer at overstocked inventory levels. Although even if GDP picks up the final quarter, the disappointing third quarter all but assures the economy will fail to break the 3% growth level for the 10th straight year, according to experts. Consumer spending increases in third quarter, with the GDP slowing in the third quarter due mostly to businesses showing more caution. Consumers continued to spend at a steady pace. As consumer spend rose at an annual pace of 3.2%, consumers were more confident than any time since the end of the recession in 2009, as spending for durable goods rose 6.7% in the third quarter. Durable goods are long-lasting goods such as cars, trucks, and equipment. Experts feel that the consumer spending will continue to be strong in the final quarter of 2015 and will push the GDP numbers back up above the 2% level. Pending homes slightly lower in September. The California Association of Realtors announced that the pending home sales index decreased 1.5% in September from August. This is seasonal and was much better than the average decline of 3.4% that we have seen from August to September over the last 7 years. Southern California showed the largest drop in pending sales. Contracts in Southern California were down 8.9% in September from August, but up 10.2% from last September. Especially in Sherman Oaks, we have a slight increase of inventory over the last month, but pending sales have definitely decreased somewhat. There's a lot of speculation that the market's going to come down next year. I kind of find that hard to believe myself because interest rates are still really good. Inventory is still really down where it should be. I mean, we're about a 3-month inventory right now, and normal market is 6 to 7 months. I don't see a lot of foreclosures coming out or short sales. When it was at 2008 and the market basically crashed, there was thousands and thousands of foreclosures coming out in the market and tons of short sales. So, maybe it'll kind of steady out a little bit because the prices have come up a lot, and just a lot of people can't afford to buy the houses right now. So it'll be interesting to see what happens with the market next year, especially locally. Feds leave interest rates unchanged at October policy meeting. Federal Reserve Chairperson Janet Yellen announced that the Fed elected to leave its benchmark rate at 0 levels at the conclusion of their 2-day meeting on Wednesday. She did say that the Fed was open to raising rates at their December meetings as they still believe that the fundamentals of the economy point to moderate growth. They've been saying that for a long time, so I'm not sure if I really believe that. It was definitely a mixed message which experts are used to from the Fed. It was widely believed that the Fed was cautious after lower than expected job creation over the last 2 months, but if job growth picks back up, the Fed will go ahead for the first rate increase since 2006. Nevertheless, the Fed's optimism did drive bond yields up slightly. Treasury bond yields rise following Fed's statement. The 10-year Treasury bond yield closed the week at 2.16%, up from 2.09 the previous Friday. The 30-year Treasury bond yield closed Friday at 2.96%, up from the previous week at 2.90%. The mortgage rates did inch up slightly this week. The 30-year rates are around 3.875%, up to 417,000, and over 417,000, it's about 4% right now. The 15-year fixed rate loans are about 3.20% for loans up to 417,000, and the ones higher than that are 3.375%. The 5-year ARM and 3-year ARM rates are both around 3% this time. Hope you guys had a wonderful Halloween and have an amazing Thanksgiving, and I'll be talking to you soon. This is Blaine Pacelli, Rodeo Realty. See you later.